Symantec was the first venture finance startup that I was involved with where we had great success. I did one little one before that. And with Symantec, we were very fortunate to deal with a number of great firms, venture capital firms. John Doerr and Jim Lally from Kleiner Perkins were on the board of Symantec for a long time, and I got to interact with them prior to the most significant investment round that gave the company the critical mass it needed to take off. And we eventually built Symantec into a very successful business, in part because of their backing and guidance. And I've done other startups, mobile automation. I was one of the 3 founders of that company. And Dave Strom at Greylock was our single VC investor of scale, and he was a phenomenal guy to work with. Then we ended up building a difficult success, but we built success. The first startup I was involved with, we went public a long time ago, but it wasn't venture finance, it was a bootstrap company. Symantec was venture financed. And of course, I've observed many other companies in this era of the microcomputer revolution and now subsequent revolutions, the internet revolution and smartphones and so forth. I've observed and in some cases participated in the process of startups raising VC money and becoming very successful. I've had the good fortune to work with a number of excellent VCs in Silicon Valley and beyond. I've done a lot of angel investing of my own, probably too much actually. I've done mezzanine investing. A good friend of mine, Safi Qureshi, and I set up our own venture capital firm in the late 90s as well. So I've sat on both sides of the table, and I've raised venture capital and invested venture capital. Not all companies require venture capital, but the vast majority of companies do need sizable amounts of capital to get launched, to build a sizable business from nowhere, from nothing. Unless you happen to get very lucky, it's almost always the case. You need sizable sums, and venture capital is the best source so far of startup capital. I've had the good fortune, as I mentioned earlier, to work with some great VCs. Kleiner Perkins, John Doerr is a classic example of a tremendous and very famous and remarkably successful VC. And Kleiner Perkins were put through the ringer forwards and backwards recently in a lawsuit which alleged gender bias. They won. They still got put through the ringer, as did the entire VC Silicon Valley community. Frankly, for good reason, because even though it's not intentional, it's still happening, right? So there needs to be some change. I've probably had an uncharacteristically favorable experience based on the rumor mill and what you hear. I've worked with some great VCs, and so they bring tremendous networks to the table. They can refer you to resources that you can tap into very, very quickly. So you save an immense amount of time and money, because time is money when you're waiting. And they have advice that can make all the difference in a moment, right? You can get a half a minute's advice from a knowledgeable, seasoned VC that can make all the difference, when it might take you 6 months or a complete failure of your business to figure it out for yourself, or to tap into marginal resources, which is what most people have access to, right? So Symantec, I think, is their market cap today is a long time later since we built the company. I think their market cap's in the $12 to $14 billion range, with about 50,000 employees-ish, right around there, from zero, obviously, in the very beginning. I was fortunate to be one of the seed investors in Ask Jeeves, which is now called Ask. That company grew and was very successful, and after I was in the first external round of financing, subsequently Ben Rosen invested personally, and then other venture capital firms endorsed and backed the company. That became a great success. But I guess the bottom line is that to build large-scale successful businesses, generally speaking, you need large amounts of capital. It's unusual to be able to get by without that. It's hard to say, right? I mean, at the time when you're in a meeting, you don't get the meeting unless somebody knows somebody. Typically, it's very rare that an emailed executive summary is going to get traction enough that you'll have a meeting. It's possible, but remarkably unlikely. Generally, it depends on having an introduction or knowing somebody. So there's obviously a big barrier to there. When the history is that very few women-led businesses get funded, then obviously that network is a very small one. And so it's automatically, in a self-sustaining manner, not as cool, not as good, not as strong. But at the moment in time when you're having these meetings, you never really know which ones are going to work. You don't really know what it was about your pitch that resonated with this particular partner at this particular firm. So you can't really be sure. But you can be sure you wouldn't have got the meeting if you didn't have an in somewhere. So equity crowdfunding is sort of is great, and it's expanding the options of small startup companies to get earlier stage capital. Yeah, so I get the sense, without having analyzed enough information, I get the sense that in general crowdfunding is not gender biased. It's more about what have you got? How great is it? Is it appealing to me? If you look at it from the Kickstarter model, or if you look at it from equity crowdfunding, which is still kind of early in its life but is doing a good job of what it does, then you see, I think, far less gender bias in those areas. And obviously, as mid-stage companies are going to get funded by the new realm of Regulation A+, as it's kicking into gear, then that, again, I think will allow the funding of companies based on merit. And when you do it based on merit only, which is what seems to be more natural when you're in a crowdfunding or internet-based environment, then it's about merit, and merit speaks for itself. You don't care about the origin of the person. You don't necessarily, in some cases, depending on the nature of the funding, you don't necessarily care where they're from, right? You care only about how great they are, how great the idea is it defensible, how big a market does it address, right? And so that's a nice thing. That's a good thing in general terms. Silicon Valley VCs, and I think, frankly, most US VCs are doing a lamentable job of funding companies led by women. The most telling metric is that 3% of VC-funded companies in recent time are led by women. And obviously that's way out of whack with where the talent lies, and is neglecting the potential that a tremendous number of very seasoned and skilled women can bring to the table. The bottom line is that in the US at least, and I think more so in the US than many so-called developed or modern economies, the VC community is underserving women. That's a fact. When you look at the sources of capital available to mid-stage companies, they're not a startup and they're nothing like big enough yet to go public, but they need growth capital and they don't need a tiny amount of it, then, receivables financing or a bank loan won't do the job. A reverse merger on a penny stock exchange has a great stigma and it's expensive. The stigma is the big thing, though, because once you've done it, you've got to earn your way out of that, and that can take a very long time, and sometimes it never occurs. So the fact of the matter is that there's been a big gap. There's been a gap of where these companies that I call the unfundables sit, that can't raise growth capital. Maybe they're running at 20 million per year in sales, growing at a reasonable clip, generating reasonable profits in a field that they lead, and they want to expand. They see structural or strategic shifts occurring that they want to take advantage of, and they need to raise capital to do so. And apart from those that I mentioned, and private placements, which are again a very narrow segment that isn't available broadly to these companies, they've been stuck. And I would say that the women-led examples have been even more stuck So they had even less options available to them. So I don't know what the SEC was planning, but what they've delivered, and I imagine this was their plan because they know the big picture better than most, if not all people, right? Because they're looking at all the metrics and the opportunities, and they're better in touch with the numbers of everything that's moving, I would imagine. They have done a masterful job, in my view, of targeting mid-range companies that need growth capital and don't have a viable way to get it in North America. So now with Reg A Plus, it's funny because Reg A Plus, the little plus sign, implies is a minor adjustment. It's like a whole new world. I mean, it is so different than the earlier Regulation A. It almost deserves its own letter in the alphabet. Pretty amazing. So what it's opening up investing to ordinary people, Main Street investors worldwide, and in some cases without limit. And it's allowing mid-stage companies to raise up to $50 million per year, and to do so in a far less complex manner, to be able to and in such a way that the investors are able to sell those shares in the aftermarket when the marketplaces are established that will facilitate that. The point being that it's legal for companies to sell their shares to individuals who can then resell them for a profit, so they're not stuck in a private company for God knows how long before they might get liquidity. So essentially, the SEC, not only in what they've done, but in the way they have done it, they've made a practical way for companies, for platforms to make offerings of companies that need to raise money, and even for companies to make their own offerings if they have the wherewithal to do that. And they've done it in such a way, as I mentioned, just adding more light to that, they've done it in such a way that it's practical. One of the most important aspects of Reg A Plus is that it's written in such a way that platforms are practically able to utilize it. It's one thing to have a set of rules, but if the way you have to enforce them is punitive or very high risk, then not many players will jump in. And what the SEC has done with Reg A Plus is a breath of fresh air, in my view. The fact that now, as I mentioned earlier, individual investors can participate, in some cases without limit, in many cases up to 10% of their annual income or net worth after removing their house from the equation. In Tier 2 of Reg A Plus, there are no state blue sky registration efforts required on the part of the companies. So again, it's a lot simpler. The reporting requirements are very much simplified compared to a public offering on the NASDAQ or the NYSE. As obviously they should be simpler because these companies are not raising as much money. They don't have the deep pockets that it takes to do that kind of reporting. So across the whole gamut, when you get to Tier 1, Tier 1 of Reg A Plus essentially makes for a much simpler registration process for the companies. They don't have to file an audit. They aren't required to report on their performance post-offering, although they'd be smart to anyway, frankly. But they aren't required to. And the only restriction in Tier 1 is it caps out at 20 million per year per company. Also not a terrible thing, right? Lots of companies could use 20 million per year. But the state blue sky laws have to be satisfied state by state, wherever the investors come from. So until the states organize it together in some way, then mostly Tier 1 is going to be a one or two state solution. So companies that have a very strong presence in one state, maybe all their customers are in one state, then in those companies can appeal perhaps to enough investors to raise the capital they need. So when you add up very wide investor base, so obviously professional investors, accredited investors, run the gamut through Main Street investors worldwide, are allowed to invest in these companies sizable sums of money in ways in which the platform can practically enforce. And then you add to that the fact that the shares purchased through Reg A Plus can be resold in the aftermarket by the SEC's rules. If the company making the offering chooses to have a lockup, that's a different issue. But the point being that the SEC is saying they can be liquid right away. That's big and saves a lot of money and makes the offerings appeal to a far wider audience, And there will be an aftermarket for those shares most likely if I'm dealing with a company that has stated that they're going to have analyst coverage and make sure so and report their results on a regular and frequent basis, etc., then that's a whole different ball of wax. It's a whole different ball game than if you are buying into a private company and it's going to be private for some indeterminate period of time. Reg A Plus is essentially a simple public offering. That's what it is. It's a smaller scale, less complex public offering. Test the waters is really a very cool thing in Reg A Plus because essentially companies don't really know at the outset. They can study the Reg A Plus rules as much as they choose to, but they don't know whether or not their company and their offering and their product and their plans for the capital they want to raise are going to resonate with the audience that's out there. Obviously, there are going to be companies that make offerings of Reg A Plus shares, offerings for companies. Companies are called issuers in this context. There will also be a number of marketplaces that will emerge in order to buy and sell these Reg A Plus shares. And I'm aware of some that are being formed as we speak. So, I would imagine 9 months or a year from now, there'll be a number, 2, 3, 4, 6 early stage marketplaces, and then there'll be too many, and then there'll be a culling process. 5 years from now, there'll be some sizable, successful internet-based marketplaces for the sale and purchase of Reg A Plus shares. And obviously the platforms will emerge too. The platforms will specialize in whatever they choose to. Some of the equity crowdfunding companies are making moves to add Reg A Plus to their portfolio. So because of the scale of the need and the scale of the opportunity, Reg A Plus is going to become big. My estimate is that by 2025, at least $50 billion a year of invested capital will be deployed through Reg A Plus. And that might sound, it is big. It's a big opportunity. It's a big market. Angel investors put $60 billion a year to work today. And that's a subset of the very wealthy people in this country, people that are better than a millionaire outside of their residence. Of those, the fraction of them that like taking these kinds of private company risks deploy $60 billion a year. So just to give you a sense, 50 billion isn't out of the range, it's in the zone. And that's a lot of capital for a number of companies that need it. There's about 800,000 companies in this mid-stage. And who knows how many of them would like to raise capital. One can make estimates, which is something which I've done. But even if only 10% of those companies in that segment want to raise capital, then a subset of them will attempt to, a subset of them will be able to, large numbers will result. At this point, because in general people are not aware that Reg A Plus exists, this mid-range of companies, they're not even looking to raise capital because when they did check, there wasn't a place to go. We are focusing on that segment of the whole market, which today is probably 12% or maybe 20%, depending on how many companies choose to become gender diverse and how quickly that happens. Obviously, over time, that's going to grow as more and more women-led businesses become successful. But that's our focus because there's a really big need there. We are focused heavily on doing a great job with Test the Waters so that companies who don't know really if it's going to work for them can check it out, try it out, kick the tires, if you will. And from that, they'll determine if it does or doesn't work without having to spend a lot of money or a lot of time. And of course, I'm sure a lot of other platform marketplaces will follow our lead in that, but we're doing it now. And by the time they're following our lead, we'll have upped the ante and we'll continue to do so.